Good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, August the 21st, 2025. Just one more day, one more dodo before we get Jerome Powell at the Fed. But what we do have today, a little bit of data today. So I just want to have a quick look at this. We get both some hard and some soft data. So the hard data we get is initial jobless claims, which, as you all know, has been very, very solid. No sign of weakness in the US labor market, really, despite we did have those downward revisions on August the 1st, which caused all the kerfuffle. But at this point, the initial jobless claims, which is, a timely and a weekly gauge of the US labor market, we're expecting 225,000, which is very, very solid. Let's see if there's any crazy sort of surprise, but it doesn't look that way. As always, we'll keep a look on the 4-week moving average. But again, that is showing pretty stable. What some people have been saying is that the continuing claims, which is expected to go up to 1.96 million, is that's showing a slightly different sort of viewpoint or overview of the labor market, in the sense that it seems that employers are not really firing people, but they're not really hiring a lot of people. And so we sort of have this sort of stability in the labor market. And one of the reasons the unemployment rate hasn't gone up more, and this is something which the Fed and Powell are looking at a lot, is that because of the drastic cuts to on undocumented immigrants coming to the US, that's basically reducing the pool of labor available. And that means that, the employment situation is not as negative, and the unemployment rate is not as high as it may otherwise have been. Anyway, so that's kind of interesting just to look at the continuing claims and just to see whether that is rising, because if that is rising, that has the sense that, people, once they do lose their jobs, and if they do lose their jobs, it's much harder to transit into something else. So keep an eye on that. Also, a little bit later on, we get at 9:45 some soft data, the S&P PMIs. Now, that's not the ISM PMIs, which are important in the US, but globally, we have all of the PMIs for the month released today. So nonetheless, this is going to be pretty interesting, because this is a preliminary number for August. So we're really getting now into, 4 or 5 months after the tariffs were first announced. So starting to get a sense of, what is actually the situation. So we get both the manufacturing and the services, and of course, a composite number. Manufacturing is expected to remain slightly in contraction territory, so just below 50 here. But we see the services is expected to, maybe come in a little bit down from 55, but still in expansion territory, so above 50, which means, remember that the ISM, sorry, not the ISM, the S&P Global PMIs is a series of questions, essentially saying, do you expect things to get better or worse, or to go up or down? So it's not really a hard data, it's more of a sort of a trend and directional survey. But nonetheless, it looks as though services is holding up. But that's going to be interesting to put those two together. And then, of course, a little bit later at 10 o'clock, we get existing home sales. And again, the narrative around the existing home sales is that with elevated mortgage levels, people who potentially want to sell their homes don't want to actually sell and have to refinance or actually remortgage, get a new mortgage at a much higher rate. And that's sort of creating a bit of a blockage in the existing homes sort of turnover and sales. So we'll have a look at that. Okay, so in terms of other stuff today, what we do have, I just want to show a little bit just about the Fed. So we had interesting, actually, no, before we go on to that, let's go on to Walmart. So we just had the Walmart earnings, which had just come out like, I think, 30 minutes ago or so. And just got a quick article here from Bloomberg, just catching up on it. So it looks relatively positive I just had a quick read through this. It looks relatively positive that the CFO, Chief Financial Officer, saying the consumer is resilient. They revised upwards their net sales to be rising from 3.75 to 4.75 this year, versus a forecast of 3.4%. So basically an upward revision in sort of what they expect to be the sales going forward by about, looks like by about 75 basis points or so. So that's pretty positive. And just overall reading through the article, they're essentially saying that, especially with the wealthier clients or customers, there's no particular problems. And even across all income groups, they've seen pretty solid sales. They're also saying that in terms of the tariffs, they're expecting that, some things might go up like 1% or so. They've absorbed certain tariff costs, and others they've passed on, but not in any great shape or form. So overall, just having a quick look at it, just reading through this, which I did, that Walmart seems to have been, fairly good results and fairly confident going forward, and fairly confident also in their ability to manage, let's put it that way, the tariff situation. Having so that's sort of a positive thing, and it's going to be interesting today. That's a little bit more positive than the Home Depot, which we saw yesterday. But again, Home Depot is a bit more tied to the real estate market. It's a bit more of a specialized thing. Later on in the week, we're going to get Target as well. So the big box stores seem to be going okay, but keep in mind that Walmart is massive and does have a lot of pricing power along the supply chain. So it's maybe not exactly representative of the broader retail space, but nonetheless, this is quite positive. And it'll be interesting to watch that stock in particular today, but also consumer discretionary and maybe the broader market, just to see if, the Walmart is sort of spreading the good vibes, so to speak. So that was definitely, looks relatively positive at first blush. The other thing I just want to have a quick look at, just in terms of the Fed, see where we're at. Obviously, we have Powell tomorrow. I'll talk about that tomorrow morning. But the market, in a certain extent, has repriced in a slightly hawkish way. There's been a sense we had the minutes yesterday, and the FOMC minutes were pretty hawkish. Essentially, if you look at what they said, they're much more concerned about the sticky inflation. They believe that's much more of a problem on balance compared to their other mandate, which is full employment. They seem relatively confident about employment. And if you look at the language of the FOMC minutes, there are a lot of mentions that, most or many, a majority of members were more concerned about the inflation situation. So if you just had to look purely at the FOMC minutes, you'd have to say, why is the market pricing in, almost like an 80% chance of a cut in September, and then, over two cuts by the end of this year? Surely there's, odds that there may not be a cut in September and maybe just one cut this year. But of course, the thing about the FOMC minutes is that that meeting happened before the revisions. I think it was like 3 days before the revisions of the August payroll number, August the 1st payroll number, where we of course had that 258,000 job downward revision, which caused a lot of dovish repricing in the market. So the question is, do we look at the FOMC minutes and say, aha, they really are focused on inflation? The market is getting a little bit too optimistic, a little bit too dovish. Or do we completely discount those minutes and say, hey, that's very much old news, and we have new significant information since then, and we need to just refresh everything and wait for Powell? I think that's the point. I would be more leaning in the latter camp slightly. I think really what Powell has to say tomorrow, he can push the narrative whichever way he wants. As I say, we'll talk about that tomorrow. But what we have seen nonetheless is that the pricing has gone down. If we just look at the September pricing, which is in a fairly tight band, it was almost up at 24 basis points, so a full cut a few days ago. But if we actually look here, so this is not the December pricing, which I often show, but the September pricing. So for the next FOMC meeting, and you can see it's pretty much a tight range here. But basically over the last, each sort of dotted line represents a day. So going back about 4 or 5 days, you can see that the market at the beginning of the week was pricing in about, 20, almost 24 basis points of cuts, which is one full cut. But if we just look and see what's happened over the last few days, that's been, a little bit sort of hawkishly repriced. We're now under 20 basis points. So we've gone from, almost 25 down to 20. So it's gone from almost 100% chance of a cut down to about 80% chance of a cut. And again, this is just a couple of basis points here and there, whatever Powell says. And then, the data and the CPI and non-farm payrolls and everything will change this in a heartbeat. But nonetheless, the market has dialed down its expectations, although still expecting, 19 out of 25 basis points cut. So this equates, as I say, to an 80% chance of a cut. So if Powell disappoints the market, there will be some very unhappy sort of doves out there, let's put it that way. And the front end of the curve will really be under a lot of pressure. Having said that, we all know that historically, especially the last 20 years of the Fed, historically, they do not like to contradict the market. They do not like to upset the market. They do not like to be too much in sort of disagreement with the market. And if the market is signaling a rate cut for September, it would be quite unusual historically, from a historical perspective, for Powell to sort of poo-poo that and say, no, that's not going to happen. Inflation's still a worry. Employment situation's wonderful. Forget about September. I think he may be a little more sort of hedged in the sense that he may be a little bit more data dependent and signal two-way risks. But anyway, we'll talk about that tomorrow, and we'll actually have the man himself, of course, on Thursday. What was also interesting yesterday, just for a blip, and we'll go back to a couple of markets here, is that Lisa Cook, who was a Biden appointee to the FOMC, She hold on, what do we have here? I don't know that I have what I need to have. Sorry, guys, I just need to bring up my charts. Here we go. Yeah. So it's interesting that yesterday, Lisa Cook, who of course was a Biden appointee, there was, I mean, I don't want to go into too much detail, but essentially she was accused by one of Trump's sort of acolytes for a mortgage fraud. And it seems that may well be the case. And Trump immediately came out, without going into too many details, and said, oh, we have to fire Lisa Cook immediately. And basically, the point is that she is, in theory, going to be at the Fed for another 10 years. And so Trump is trying to, it seems, have her fired, which potentially could open up another sort of board member seat or seat on the FOMC, which would give Trump the ability to place yet another sort of dove or pro-Trump, pro-cut kind of person. Not only Stephen Mirren is probably going to be there, but let's say potentially now someone replacing Lisa Cook. We're a long way away from that. At the end of the day, Lisa Cook actually came out and said that she wasn't going to be bullied, she wasn't going to step down, she was going to explain everything. But the point is, there is a huge amount of political pressure and being put upon her, and her life is going to get very, very difficult and uncomfortable for the next few weeks. Because definitely the White House has zeroed in on her as as a potential target to be replaced and to force her to resign. And clearly now there is a very strong political agenda of the Trump administration of trying to find any weakness possible. They're obviously combing through everybody's records and legal documents to see if there's any sort of inconsistencies. So that's something to look out for. So the market reaction was quite interesting on the Lisa Cook headlines. It didn't last too long, but basically we saw the front end of the curve sort of go up, so the yields going down on this idea that, you know, one more person, one more dove on the board of governors. So we saw the yields coming down at the front end and the price of those bonds going up. We also saw the US dollar weakening, and we saw gold going up, and we also saw the stock market selling off just a little bit, just for a, you know, it was a very temporary action, but definitely that is becoming an issue, this extra politicization of the Fed. And let's just keep an eye on what happens with Lisa Cook just over the next few weeks, because there's definitely a lot of resources behind the scenes of being focused on her to try and blacken her name. Also today we do have Bostich. Now keep in mind he's speaking. He's a voter. He's signaled before that he'd be happy to do, you know, a cut, but maybe just one cut. So it's going to be interesting to see if he's leaning a little more dovish or remains just in the one cut camp. He's speaking, I think it's this morning that Raphael Bostich is speaking, so let's keep an eye out for that. Okay, apart from other things, I will just grab some tea. I just want to have a quick look at the oil market here. It's kind of interesting what's happening with the oil market. Obviously, the geopolitical situation is such that it looks as though any kind of deal between Russia and Ukraine is going to be quite messy and complicated and will take a lot of time and needs to involve China and all kinds of things. So the oil market is waiting to see the situation on sanctions. Will sanctions be completely removed as a possibility, or will Trump actually go back to the possibility of imposing sanctions on Russian oil exports, and not only on Russian oil exporters, but also on those who buy Russian oil, which, for example, would affect the Indians, who have pumped up about 40% of their oil imports now come from Russia. And before the Ukraine war, I think I was reading yesterday, I think it was only like 5% or so. So definitely India is a key player here. But what is giving a little bit of a sort of a baseline support for the market at the moment? It's kind of interesting. Yesterday we had the oil inventory numbers in the US. And you can see that they came in as minus 6 million. So that's a 6 million barrel drawdown, which is pretty impressive. And I've got some numbers to look at that. We also had the gasoline inventories coming down at almost a negative 3 million. Whoops, almost negative 3 million. So that was very supportive for the oil markets. And if you actually look at the curve here, as I was saying, I think a few days ago, you see the curve here of the WTI. Each dot represents one sort of month in the future. You can see it's still very much in a backwardated state. So this is indicating quite strong physical demand. And although the outright price for sure has come down quite a lot over the last 2 or 3 weeks, you can see that the shape of the curve is still indicating physical demand for those front contracts, for front delivery, for early delivery. But what is interesting here is that It kind of flattens out quite a lot in 2026 here, and then sort of this curve steepens in terms of the price going into 2027. So it's almost as though the market's saying, "Hey, things are going to be okay for the next, 3, 4, 5 months." But as we go into 2026, there could be a lot of surplus, and it's interesting to look at the context. Let's look at just some of the reasons for some positivity in oil, and one of the just looking at a few metrics here. So you can see here the inventories, the 5-year average. This is the 5-year range in the blue. And you can see the 5-year averages, the red. So look where we are now. We're actually at 2025. We're actually at the lower end of the range and well below the 5-year average of oil inventory. So this is in the US. So that's actually quite supportive. So even though the global economy is not wonderful and demand from China seems to be softening a little bit, et cetera, et cetera. The reality is that the oil inventories are still at quite a low level, and that is putting in a bit of support. Also, you've got the total US refinery demand, and you can see here that that's above average. You see here again that it's actually above the 5-year sort of range, and it's well above the average. So refinery demand and the numbers we got yesterday were actually very, very, very positive, basically saying that there's a lot of refinery activity churning through crude oil. So that's a positive for oil. And if you look at total oil exports out of the US, I mean, this is obviously a very choppy number or a noisy number, but you can see here on the red, which is sort of the moving average, you can see it's starting to turn up a little bit. And so that's also draining some oil supplies, out of the US at least, which is not, Dubai oil or Brent, but nonetheless, that's a little bit supportive. And then you can also looking at the numbers for if you actually look at jet fuel. Jet fuel is actually there's very high demand for jet fuel, apart from the distillates and gasoline and other products. But jet fuel is actually sort of pretty positive. You can see here 2025, which is in this sort of thick black number, is also doing pretty well. So what I'm trying to say is that there are some negatives going into 2026. There's talk of inventory surpluses, because remember that OPEC Plus are bringing on back online over 2 million barrels per day of oil supplies, which they'd shut off production in the past a couple of years. But basically this year, 2025, every sort of month they're cranking up their production a little bit, and eventually that's going to add up to about 2 million barrels more per day compared to where we were in, let's say, 2023, 2024. So the idea, one of the reasons for the oil curve sort of having this dip in 2026, that it well could be that there will be some buildup in inventories globally in 2026 as a lot of that OPEC plus oil comes back onto the market, and we potentially have a softening in the global economy. But just one final thing, just want to share with you as well, just in terms of positioning. Whoops, what did I just do there? I think I just pressed the wrong button. So let me just go back to that chart. Oh yeah, so this is the Commitment of Traders report, and kind of interesting here, looking where we're at historically. Historically, we're at a very, very low level. So this is basically the WTI contracts traded on the ICE, but especially the Chicago Mercantile Exchange, so the CME, but also Brent. But you can see here, if we look particularly at the WTI, which is the US benchmark, of course, you can see here that we're at levels actually almost negative, which we haven't been sort of historically for like ever, like a long, long time. If you put together the WTI, Brent, all the contracts actually down to negative. But just going back to the American WTI, speculators are very, 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 very heavily short, like historically very heavily short. So what that means is that two things. There's not necessarily a huge amount of fuel for extra shorts, because every man and his dog basically is kind of short. So there's not a huge amount of extra potential. Obviously people can still short, but in theory, a lot of people are very, very short. That also means that in the possibility for a short squeeze is definitely exists, because the market is positioned so in such an extreme short way that if we were to get any kind of positivity, geopolitical news or just sort of technical news, some of this inventory stuff, and we can maybe get some kind of short squeeze in the oil. And I'll just put it back on the chart here of oil. And you see here that, we've come down a lot. We're below all the moving averages. But as you can see, it has started to stabilize a little bit. There's definitely a little bit of support around some of these levels, a little bit of, sort of volume around these levels here, $61, $62. Anything below there becomes probably a little bit exaggerated. And you can see oil starting to push up a little bit. And my point is that if you look at the positioning, if this does start to push up and there's any kind of positivity, we get some stops up here at 64. We could see this up back into, the 65, $66 range fairly soon on a short squeeze. But again, it would probably need to have a match lit underneath the fire. We need some kind of catalyst to cause that, but that's definitely something interesting to keep an eye on. Okay, guys, I'll leave it there. As I say, we do have 8:30. We have the initial jobless claims. Then we have some of those PMIs coming out at 9:45, and the existing home sales at 10 o'clock. Let's keep an eye on all of that stuff. Let's see what Bostich has to say, and of course, no doubt, our friend in the White House will be tweeting away furiously. And then, of course, we have the big one tomorrow with Mr. Powell at Jackson Hole. Thanks very much. Have a great day, and we'll keep this going tomorrow. Thank you.